that as of now there is only optimism, no cynicism, no skepticism. There is faith and trust in fund managers, which is implicit right now, and nobody seems to be focusing on the bad news. Well, he's of course talking about the US markets, not Indian markets, but back home in India, everybody seems to be focusing on only on bad news, which is IL&FS, higher crude prices, and a lower rupee. Gautam, what are you telling the clients? Buy the fear, or time to look at alternates, take some cash away? It will not hurt you if you move 15-20% of your allocation to debt. What is the line of communication from UBS?
Good morning. So our view is still same. The risk reward, despite the correction we have seen till now, is not attractive yet. So our recommendation is still not a buy on dips market. Again, obviously, if you're looking at a 3-year, 5-year long-term India story, then obviously it's all fine. Even these levels are fine. But for people looking at 6 months, 1 year kind of view, there's still not a buy on dips market. There is possibly more downside from current levels. Our fair value for Nifty still remains 10,500 for December 18.
After a 15-20% correction in average mid-cap stocks and a 10-15% correction even in good private banks or NBFCs, the risk reward ratio is not favorable. Are you of the view that earnings will disappoint us, or liquidity will ensure that markets will remain low?
So earnings cuts will definitely happen. The street expectations of 23-24% growth for Nifty in fiscal 19 is very unlikely. Our base case is 13-14%, and our base case of 13-14% builds in some positives from NPL cycle bottoming out. So if that doesn't happen, then obviously there's a downside to that. Why we say risk reward is not attractive? It might look cheaper than it did few months back, but from a long-term average, medium-term average, and looking at the underlying growth trends, the market is still expensive. And just as you mentioned about mid-caps, the relative valuation of mid-caps to large caps, or the mid-cap index to Nifty, on a trailing PE basis is still trading at 60% premium. This has come off from a 100% premium few months back, but if you look at long-term history, it's typically trade in line, or at best to 20% premium like it did in 07-08 peaks. So this kind of premium is still off the charts. It's been largely fueled by local retail flows, which again is coming off, and in our view is vulnerable and will be dependent more on how market returns are rather than any other factor.
Gautam, hi, morning. Want to talk about your latest note, talking about liquidity woes as well as its impact on NBFCs. So tell us, Gautam, I mean, what is it that you do? And NBFCs, I'm calling them NBFCs at large, within that segments like HFCs in particular. Do you buy this decline because most of them seem to be getting cheaper? And, you know, the kind of swift pace of fall that you've seen, it's getting a little scary, really. And, you know, the fact of the matter is that you've seen everything from an M&M Financial, Indiabulls Housing to the creme de la creme, even a Bajaj Finance fall with the same kind of, ferocious move. Do you buy this decline, or do you wait it out because NBFCs as a cluster in times like these would find it tough to post those kind of growth numbers that they have been in the past?
Look, the backdrop and the reality is that India is moving away from a benign liquidity environment over the last 3 years to a tighter liquidity environment. And this has been happening for the last few months, possibly, where India moved from balance of payment surplus to deficit. RBI is no longer in an accommodative stance. Credit growth is picking up, and demonetization benefit is behind us. So it's been happening, but it kind of hit the markets over the last 2-3 weeks when these events came out. And any which way you look at it, it might be a liquidity crunch near term, which is a base case, or an extreme tail risk event that it shows a further asset stress in NBFCs, in IL&FS, etc., which is not our base case. Any which way you look at it, what is going to definitely happen is NBFC's growth and margins will be lower than what they were pricing in and what the street was looking at. So that this is kind of a reality check for the expectations out of that. So some of the correction is definitely makes sense even for the quality ones. The way ahead for us, for NBFCs, is from a strategy portfolio positioning wise. As a sector, we are tactically underweight because these stocks and sectors will take time to digest the reality of a tighter liquidity environment and valuation correction. Having said that, there are obviously individual names which could be interesting for investors looking beyond the horizon of 6 months, and those will be names where they have ability to raise funding even in a tight funding environment because of pedigree, track record, parentage, etc. or their ability of passing on the higher funding cost is well demonstrated historically. So there will be individual names, but the broader segment-wise segments where their yields are higher or the pricing power is much more evident are the segments we'll prefer, rather than just making a broad sector view.
But I look at your top bets and I see an ICICI Bank, Axis Bank firmly part of that list. Is it really the transition story which is likely to come to the fore? Because I know that there have been a fair number of positive views on both these stocks through the pressure they witnessed on their NPA cycle. I think the market kept conviction that at the time when things clear out, the pickup would be pretty strong. Do you think that with the leadership transition, that argument or that logic only gets more momentum?
So you can't comment on individual names, but yeah, broadly retail liability driven banks will do well. So the NPL cycle bottoming out is fairly well known. There's been management change in few banks which has helped investor sentiment. But I think one of the underappreciated facts about these retail liability driven banks, which should play out over the next 6 months to 3 years, is that the value of their retail liability franchise was not showing up in their earnings over the last few years because of a benign liquidity environment. That will show up in earnings in the next few quarters and few years, and that could lead to earnings upgrades also for some of these banks, assuming they execute well. So that's the reason we are overweight retail liability driven franchises in our portfolio.
So Gautam, if your view is that Nifty should come down to 10,500, which means that the downside may not be large. I mean, you're not positive because your fair target is still lower than what the current level is, but your fair target for Nifty is not very far away. So according to you, the bright way of looking at things is that we are nearing the correction and the correction may not be more than 5-6%.
So when we talk about index is a very broad, in India is a very diversified index. So a 5% correction in Nifty would also mean a much sharper correction in the broader market. So we still underweight small and mid caps despite the correction we have seen till now. This is a base case kind of view. Obviously there are scenarios which can play out for Nifty, and this is assuming there is no further credit shock, there is no big EM blow up, nothing of the sort. This is a steady state fair value for Nifty.
So Gautam, last time when we saw a similar similar kind of a cycle where rupee was weak, crude was higher, market moved into mid and small cap stocks because they were available at a throwaway price, and we saw a 4-5 year bull run there. Markets also migrated towards consumers because consumers gave you this proposition of no debt and no negativity which came because of uptick in interest rate cycles. So where do you think cash would move now? Where do you think fund manager positioning would move now? Because consumers are expensive and small and mid cap stocks are also expensive.
That cycle was different. That cycle, again, as I said, was a benign liquidity environment where there was strong local retail flows apart from a global risk on environment. That works differently. Now the reality is that NBFCs will see slower growth, and there will be some collateral impact for consumption also, because consumption growth in India over the last 3-4 years, one of the interesting points we've been making for a while is it's a very unique phase where consumption has been growing much faster than household incomes for the last 3-4 years, and this has never happened in India's history. And this gap has been happening because household savings have collapsed, and also as consumer leverage has gone up. So with NBFCs slowing down, there will be some collateral impact there also, not across the board, but in select pockets. But as we have seen over the last 3-4 years, and even now, just lower earnings or lower growth doesn't really necessarily disappoint stocks or derate stocks materially. What will matter for consumers is what happens to the broader economic pickup. If there's a cyclical recovery, consumers will underperform. Otherwise, they'll still be the popular choice for many investors to hold on to.